This is the first of 36 sessions in a class that I like to call Corporate Finance. To me, corporate finance is more than a collection of equations, metrics, and models. It's a set of first principles that govern how we run businesses. And in this class, I hope to lay out those first principles, set up some themes for the class, and use it as a roadmap for the remaining 35 sessions. But welcome, and I'm glad you've joined me in this class. Welcome to the introductory session on corporate finance. In this session, what I hope to do is lay out my vision for what this class is going to be about. Talk a little bit about the first principles that I think drive every corporate financial decision. Set up some broad themes for the class and lay out a roadmap for what's coming ahead. So let me get the show on the road by first giving you my vision of what corporate finance is all about. If you ask most people what they think corporate finance is about, you'll get a variety of answers. There are some people who think of corporate finance as an extension of accounting. Others think of it as financial modeling. Still others might think of it as a banking subsector. That's not what I think about corporate finance. To me, corporate finance covers any decision that involves the use of money. That's an incredibly self-serving definition because I've just said everything is corporate finance, and I truly believe this. In fact, when I teach my class to the MBAs, and it's a corporate finance class, I tell them that everything else they do in this program is in service of my class. Marketing, accounting, operations research, corporate strategy, they're all pieces of a much larger puzzle, which to me is corporate finance. So with that setup for corporate finance, let me lay out the three objectives I have over this 36-session course. The first is to give you the tools, the techniques, the methods, and the models that are part of modern corporate finance. Over the last 60 years, we have developed lots of tools and techniques, and I will present those tools and techniques to you. The second and bigger vision is to give you the big picture of corporate finance, to show you where these tools fit and how they work together. Because all too often in corporate finance, you see people who can use the tools, but don't get a sense of where they fit in the big picture. And there's a third objective I have, which is going to sound a little strange. I think corporate finance is an incredible amount of fun. It's like doing a crossword puzzle where the pieces fit together, and when you see them fit together, you feel an incredible sense of satisfaction. So those are my three objectives, and perhaps at the end of my 36 sessions, we can come back and see if those objectives were advanced during the course of these sessions. So let me set up the corporate finance view of the world. To do this, I'm going to go back to something that you should be familiar with from accounting. It's an accounting balance sheet. You've all seen accounting balance sheets, right? There are assets and there are liabilities. On the asset side of the balance sheet, you have current assets. Those are accounts receivable, inventory, cash, etc. You have fixed assets, land, building, equipment, machinery. You have financial assets, which might be investments in other companies. And you have intangible assets. Sounds fancy, but in an accounting balance sheet, that intangible asset is usually just goodwill, which is really not an asset at all. It's a plug variable. On the liability side of the balance sheet, you have current liabilities, accounts payable, supplier credit, deferred taxes, deferred other items, maybe short-term debt and short-term portion of long-term debt. You have long-term liabilities, bank loans, corporate bonds. You have shareholders' equity, which is really the ultimate backward-looking number. And increasingly on accounting balance sheets, other liabilities have started to show up. Underfunded pension obligations, underfunded healthcare obligations. But that's where we usually start when we get familiar with a company, with an accounting balance sheet. The accounting mindset, though, is a backward-looking one. Its job is to record what happened last year, or the last 2 years, or the last 5 years. In finance, we'd like to switch focus. We're forward-looking in finance, and to help you in this forward focus, I'd like to offer you a financial balance sheet. A financial balance sheet at one level is simpler than an accounting balance sheet. At another level, it's far more complex. There are only two items on each side. That makes it simpler. But here's what the two items are. On the asset side of the balance sheet, the first item is assets in place. These are investments you've already made as a company. So if you've been around a long time, you might have quite a few investments in assets in place. The other category is mysterious. I call it growth assets. What's in there? This is the value attached to what I expect you to do next year, 2 years from now, 5 years from now, forever into the future. It's kind of scary. I'm giving you credit for investments you haven't even thought about yet. So on the asset side of the balance sheet, you have assets in place and growth assets. Frankly, I don't care whether they're tangible or intangible. That is a distinction that accountants might think matters, but to me in finance, it matters very little. On the liability side of the balance sheet, there are only two items. There are only two ways you can fund a business. You can borrow the money, and generically we're going to call it debt, or you can use your own money, and we're going to call it equity. What sets them apart? Debt gets a first claim on the cash flows. Basically, when you make money each year, the debt holders get paid first. They get very little management control of the company, and if the company goes into bankruptcy, they get first claim on the assets. Equity gets whatever's left over, and in return for settling for that residual claim, equity investors run the company. So that's the financial balance sheet, and it's going to be a very useful framework for us to return to over and over to think about how corporate finance looks at the world. So what I'd like to do now is lay out what I think are the three basic principles that govern corporate finance. These are principles that I use to think about running any business. I'm going to call them generically the investment principle, the financing principle, the dividend principle. Let me state again what they are, and then we'll come back and fill in the details. Here's what the investment principle says. When you as a business go out and make investments in projects or assets, make sure you earn a return on those investments that exceeds some minimum acceptable hurdle rate. Sounds like a buzzword, right? So let's put some flesh on those words now. The minimum acceptable hurdle rate should be higher for riskier investments and lower for safer investments. Make sense? If I came to you with a really safe investment, you might settle for 6%. If it's much riskier, you might demand 15%. Now, we haven't defined risk and talked about how to convert into a hurdle rate yet, but that's why we have 35 sessions to come. That hurdle rate should also reflect where you raised the money, whether you borrowed the money or used your own money. So the hurdle rate should reflect the risk of what you're investing in and where you come up with the funds. The return on investment should be based on cash flows, as opposed to what? As opposed to earnings. Should reflect when those cash flows come in. You prefer to get those cash flows earlier rather than later, and you got to figure that into the process. And any side costs or side benefits have to be built into those returns. As I describe it, there's no garnishing allowed in investment analysis. So the investment principle says go out and find investments that make a return greater than your minimum acceptable hurdle rate. The financing principle is also very simple. It says when you go out and decide how much debt and equity to take, find a mix of debt and equity that maximizes your value as a business or minimizes your hurdle rate. In other words, you want the lowest hurdle rate you can. And if you ask me what kind of debt should I take, my answer is going to be very simple. Tell me what you own. If your assets are long-term assets, your debt should be long-term debt. If your assets throw off cash flows in euros, your debt should be euro debt. It's straightforward. We choose to make it complex. The dividend principle says when you go out and look for investments and you can't find investments that make your hurdle rate, don't push your luck. If you cannot find investments that make your hurdle rate, take the cash out of the business. There's no glory in growth for the sake of growth or survival for the sake of survival. And if you're a publicly traded company, giving cash back to the owners takes the form of either dividends or stock buybacks. Which one you use should depend on what kind of stockholders you have. And in doing all of this, your investment decision, your financing decision, and your dividend decision, you have a singular objective. It's to maximize your value as a business. This is corporate finance on one page. What I'd like to do is use these first principles to draw up some very broad themes about corporate finance, and they're pretty much what you'd expect to see. Here's my first one. Corporate finance is common sense. Because think of what I've just said. If you can raise money at 8% rather than 9%, please raise it at 8%. And if you've raised money at 8%, don't go out and take investments that make less than 8%. Now, part of you is saying, I don't need a corporate finance class to understand that, and you're right. There have been great business people through the ages who've never taken a corporate finance class, who've never gone to school. They get those base principles, because if you get those base principles, you're going to be okay, because that's really what drives a good business. So the first theme that I'd like to establish is when you look at something, put your common sense to use. When a model gives you an answer that doesn't make sense to you, you might want to take another look at that answer. The second theme in corporate finance, it's focused. What I mean by that is you have a singular objective in corporate finance. It's to maximize the value of your business. So everything you do as a business is passed through those lenses. So if you came to me and asked me, does this make sense? Should I do this or this?
I have a way of breaking the tie because I have a singular objective. There are other disciplines which might have six or seven objectives. They might actually sound better than corporate finance, but they don't have the focus that corporate finance gets because it's so centered on maximizing the value of the business. That objective, though, can get into trouble. So we'll come back and re examine when that objective makes sense and when it doesn't make sense. Here's the third thing to think about in corporate finance. Businesses go through life cycles just like individuals do. People are born, they grow, they become mature, and they go into a declining phase. Companies do the same. And if you tell me where your company lies on the life cycle, I can pretty much tell you what corporate finance decisions make sense to them. In this chart, for instance, I've contrasted two companies. One is a high growth company, and the other is a mature company. If you look at the high growth company, it gets most of its value from growth assets, very little from assets in place. In other words, everything lies in the future. The mature company gets most of its value from assets in place. The mature company is a company called Con Ed. It's a regulated utility. The high growth company could be any tech company you want. So you can put in a Yahoo, you can put in a Google, you can put in a LinkedIn, whatever growth company comes to mind. So if you think about a mature company versus a growth company, here's the contrast when it comes to corporate finance. And you can state it in terms of those first principles we talked about. A growth company has its entire value coming from its investment decisions. So everything runs on making those decisions well. You'll have a lot of decisions to make. It should basically try to fund those decisions primarily with equity, and here's why. If you're a growth company, most of your value lies in the future. If you borrow money today, making those interest payments, you might not be able to do because you don't have the cash flows coming through today. So if you're a growth company, here's what I'd expect to see on your balance sheet. Mostly equity, very little or no debt. And if you ask me how much you can afford to return to your stockholders, if you're truly a growth company, my answer is going to be either not very much or nothing at all. Because if you're a growth company, everything you make is probably going back into the business to create future growth. In contrast, think about a mature company. It's got most of its investments and assets in place. It doesn't have very many growth opportunities. So when it makes money, it doesn't have much to reinvest in. So it can afford to pay out a lot more in dividends. It can also afford to borrow a lot more money. So one very simple template that you can use for corporate finance is to think of where your company falls in the life cycle. And if you can tell me where it falls in the life cycle, you can probably also tell me what kind of decisions you'd expect it to make in terms of investments, financing, and dividends. Now let me move on to the fourth theme that I hope to establish. I think corporate finance is universal. I think, in fact, the title for this course is a bit of a misnomer, because when you see the word corporate, you're probably thinking that much of what we're going to talk about is only for publicly traded corporations. Nothing could be further from the truth. The principles we're going to lay out matter just as much for private businesses as public companies, small companies as well as large companies, emerging market companies as much as developed market companies. So rather than parse different companies, we're going to look at what they share in common. Corporate finance principles really are unchangeable across continents, across markets, and across types of businesses. And here's my final theme. Once in a while, you will run into someone who says the corporate finance principles don't matter to them. And usually that someone should be better informed. They perhaps have the right education, they've gone to the right schools, they're working at the right places, and they think because of those reasons, they can violate first principles and get away with them. I have some bad news for them. If you violate first principles, it's not a question of whether you're going to pay a price, it's when. And perhaps you won't pay the price. Your clients might pay the price. So if there's a common theme that's going to run through everything we're going to do in the next 35 sessions, it's establishing first principles. Because I firmly believe that if you violate first principles, it's going to be incredibly costly. So with that set up, let me lay out how this class is going to approach corporate finance. I describe this class as an applied corporate finance class. What I mean by that is I'm not going to talk about theories and models and equations and metrics standing alone. I'm going to apply them to real companies. In fact, these are the 6 companies I'm going to use to establish corporate finance principles. The first company, of course, is Disney. Why did I pick Disney? Because everybody knows what Disney does. Large US entertainment company. I'm going to take Disney through every aspect of corporate finance. The second company I'm going to use to establish corporate finance principles is a company called Vale. Vale is a Brazilian mining company. Why did I pick violate? To get as different from Disney as I could. Service company, commodity company, developed market company, emerging market company. It'll allow us to look at what they share in common and what they might do differently. The third company I'm going to use to illustrate principles is a company called Tata Motors. It's part of a family group in India called the Tata Group. I'm going to use it both to talk about the special travails that manufacturing companies face, as well as what it means to be part of a much larger family group whose interests might actually be different from the interests of the company. The fourth company I'm going to use is a company called Baidu. Baidu is a Chinese search engine. In fact, it is the dominant search engine in China. I want to use it to talk about Chinese companies because they're front and center in terms of economic growth now, what they share in common with the rest of the world, and how corporate governance can be an issue with Chinese companies. The fifth company I'm going to use is Deutsche Bank. Why? Because I want to talk about a regulated financial service company and the constraints that are put on you in terms of corporate finance decisions. The final business I'm going to use is really not a company. It's a small, independently owned private bookstore in New York City that I've changed the name on, and I'm going to call Bookscape. I'm going to use Bookscape to illustrate how the owner of a small private business faces exactly the same decisions that a large publicly traded company faces. And in fact, the consequences for making those decisions badly are much greater when you're the owner of a small private business. So, small to large, private to public, developed to emerging markets, these 6 companies will be my lab experiments that run through these 35 sessions. So here's the roadmap for what's coming. We just finished the first session. We have 35 more sessions to go. In the next 2 sessions, I will revisit that objective in corporate finance, maximizing the value of the business, talk about what's good about it, and when it can get into trouble. In the next sequence of sessions, we're going to look at the investment principle, and that's going to take us almost halfway through the class, laying out first how we come up with hurdle rates, and then talking about how that plays out in measuring returns. Then we'll move on to the financing principle, and that'll take us about a third of the class, looking at the right mix of debt and equity for a company and tools for coming up with that mix, and then finding out what the right kind of debt for your company is. And we'll close by looking at the dividend principle. At the end of the class, we'll pull all these principles together and talk about how they play out in the value of a company. I hope you'll come along with me for the ride because it's going to be a lot of fun. Thank you.